Welcome back to the channel, guys. Wagwan, you know your boy Shamari here. Welcome back to No Role Models. I will tell you them say, yo, you can go chop the market, bro. You don't necessarily have to chop the line. Alright, so today we're going to talk about unit trust, ETF. Can you trust them? I'm not sure. We're going to find out. See you in a few. Boom, I'm back in it. You see me? What is unit trust? Alright, so basically a unit trust is a pool of funds, pool of investors' funds, given to an expert, a manager, fund manager, to invest in specific instruments. Simple. Now what are those instruments? Instruments can be bonds, short-term loans, stocks, real estate. Simple as even a baby can understand it. So that's it. Pool of funds given to an expert, fund manager, to manage on your behalf. Get me I say? To give you a specific return. Every day the fund is assessed and appraised and given a cost based on fund performance, based on cost for for management, and some other local fees. So we're not going to discuss that enough for us. Now, why should you have a unit trust? Now, as I say, I give experts your money now and say, go out there and your specific job, Mr. Expert, is to make me money. So, you know, that kind of tense, but you get me. That's all it is. You give the experts the money and say, yo, make my money upon this. It's not like a bank where you're saying, I'm giving you money to keep this safe. Keep this safe for me, Mr. Bank. No, you're giving the experts the money and say, your sole job, your only job, you have one job. Yeah, your only job are for bringing in money for me. Right? And that's why it's a good instrument. It's a good vehicle to have a part of your portfolio. Because they being the experts, they have all the machine, they have all the technology, all the algorithms, they have everything they need to be successful, which you probably as a retail investor don't have. You're not privy to how the market moves or as quickly as the market moves like they do. And so because of that, rate of returns normally outperform many retail investors. Right? Now, I must say, nothing in the investment is guaranteed, and so you invest at your own risk. Yes, a lot of our companies out here have great track record of doing amazing in the past. That don't guarantee. So always talk to a financial advisor or a fund manager before, or a wealth advisor before you go ahead and invest. But as a vehicle, just solely as a vehicle, not telling you who for go choose or what exactly for invest in. Just talking about the instrument as a whole. As a vehicle, I tell you, it's very good. But if that is unit trust, now what is ETF? Now imagine you have stocks. A company on the stock market is a stock, right? And because it's on the stock market, now you're privy to trade. So you can buy it at a certain price and sell it back at a certain price. But what if that stock you were selling was not a company, but a pool of companies? That is an ETF. So an ETF, an exchange traded fund. Think of it as a mutual fund placed on the stock market, which you can buy and sell. You have two ways to benefit from that. One, you buy it and sell it at market value. So whatever the market deem is good value for the ETF, that's what you sell it at. So if you bought it at $1, you have a chance to sell it back at $2, assuming the market say it worth the $2. No, that's one. Two, diversification. Now, why diversification is key? If you were to go out there now and say, all right, I'm going to diversify my portfolio, I'm going to buy NCB, I'm going to buy Sagicor, I'm going to buy NCB, I'm going to buy Sagicor, I'm going to buy Scotia. that probably going to work out very expensive for you. You might be can't afford that, bro. But if you say, all right, you know what, I'm going to buy Sagicor Financial, right? Which they invest in a lot of financial. I have the list out of my head, I have the list right now. But them invest in a lot of financial companies on the market. You essentially get a hall pass into the financial market without having to be exposed to any single company. Now, if one company in the portfolio goes down, your portfolio is hit. But one, the value of the portfolio, because the ETF is determined by the market. So if the market don't see it as a good deal, you probably don't lose. One, if you get what I say. If the market don't see, let me get it. I don't want to call no company, I don't want to wish nothing bad on any single company. So I'm going to say, B Financial. B Financial is a part of the ETF, right? And you buy into the ETF. Now if B Financial goes down, they had a terrible year and the markets are not keen on B Financial. If you had bought into B Financial, more than likely you would have lost. Based on how much damage B Financial take, you probably lose a lot. But if you buy into the financial ETF and B Financial goes down, but the market still feel that the power of the ETF is strong enough to withstand B Financial going down, you still get a profit. Or at worst, if you lose, you don't lose a lot, or you break even. Because if other very valuable stocks are part of the portfolio. That is the beauty and the magic in diversification. So even though you have money at risk, you're not exposed unless the financial sector itself crumble. And then I better pack up a bag and go yard. But so that's it. That's unit trust. That's ETF. Pros and cons with unit trust. For unit trust, you're buying a unit from a financial institution at a set cost, hoping that the unit will outperform what you bought it for, and as such will go up in value. And so you earn a rate of return based on that performance. ETF is not based on anything but market preference. And if the market deems it good enough, then you win from that side. Those are the difference with ETF and unit trust. Two very powerful vehicles. But, as I always say, do your research, analyze, and speak to your financial advisor. Remember, guys, you can always chop the market, bro. You don't have to chop the line. You see me? That's Shamari. I've been good. Hope you have learned a lot. I'm out.